Hold on. All right, Jay, we're live.
Everybody, thanks for joining the Finance of America Mortgage Professional Hangout. So the reason for doing these is to give you guys information, whether you're a mortgage professional, a realtor, or a client of ours, or a buyer that's looking to purchase a home. We want to give you the information and the education to help you in some of your decision making. So today we have William Brown, who is the director of our renovation department here at Finance of America. We're going to go over some of the different renovation loans, one in particular, a 203K, which is an FHA loan. We're going to give you a little education on a little background, nothing, kind of touch more on a simplistic form, how they work and what to expect, how to market them, and it's a really great product. So we also have Scott Solari on here from Viral Marketing, who can kind of, Scott, if you could help the audience out if they have any questions, where they can go.
Yeah, so if you have any questions, there's little square applications up in the right corner. You can click in there and you'll see different apps. One is Q&A. It's like a blue application. Click on that. Allows you to ask questions. This is interactive. We want to be interactive so that we can get your questions answered. And we'll go over this again, Jay. I'd say in like 10, 15 minutes when a lot more people jump on.
You got it. Sounds good. So, well, again, welcome everybody, and I want to introduce our William Brown from our director of our renovation department here at Finance of America. So, William, thanks for joining me today on the Hangout. And if you could give the audience a little bit about your background, where you come from, what you've done in your illustrious career, and give some people some insight on what a renovation loan, and we'll obviously dive into some other things.
Okay, well, thanks everybody. Welcome and thanks for coming. And yeah, as far as mortgages go, if it doesn't really have a repair escrow or construction escrow, I think it's pretty boring. I've been doing renovation loans most of my mortgage career. I did I-10s. I worked as a LO for about 4 years and started doing I-10s, if you guys were around when we had non-documented immigrant workers who pay their mortgage, like they don't fail on their mortgage. We did those for a while, and then I started doing 203K and home style. Before the mortgage business, I did lots of different things. Farmed for a long time, taught high school, built houses, renovated houses, and I just think that there's a huge market opportunity for renovation loans. I think people don't really use them as well as they could be used, or as often as they could be used, either on the loan officer sales side or on the realtor side to help people get into their houses. And so our goal at Finance of America is to change that. I did originate them on the street for about 7 years, so I know what your pain is, and we designed a system at my previous employer to address that for both loan officers and realtors. So I think you guys that are hesitant to either sell them or realtors don't want to talk to borrowers about them, you have a better way that I think if you try it, you'll be very satisfied. I don't know what else you want me to say, Jay. I could this long bio.
So let's get into a 203K loan. Obviously, it's a renovation loan. Are there different types of 203K loans?
So we offer both types. There are two types. It's actually one type of loan with two variations. A smaller one, which is capped at $35,000 for all your renovations, and really is a cosmetic loan. So those of you that have been around for a while, it used to be known as the I can't remember what it's called. Streamline, FHA 203K, and now it's called the limited, which is a far better description because what they've done is they've limited what you can do for the standard 203K, which is the first one. So this is really a single close loan that funds all the hard and soft costs for repairs, remodeling, and renovations. And there's no work done prior to close, so everything is escrowed, and my group manages the contractor payments and disbursements, so you guys don't have to worry about that. The people do get paid on time. And you can use it for, the limited one is really suitable for cosmetic things, because all in you're looking at $35,000 in repairs, and I think that probably, I'm going to go out on a limb and say probably 50% of the regular FHA loans that people hurry up and close as just regular FHA loans, they leave their borrowers hanging in the wind, and they're going to go spend $10,000 or $15,000 fixing up their house. They should have done a limited 203K. Maybe it adds 2 or 3 weeks to the process, but in the long term, your borrower's happier, their finances are more stable, and you get way more referrals when you help your borrower get the right mortgage. So that's the limited. Standard is the big one, and it's FHA's idea that you can actually tear a house down and rebuild it. And often you can't because of material cost, but in theory, you can tear it down and rebuild it. but you got to use 100% of the existing foundation. So if there's no foundation, it's not eligible. Or if you break the foundation, it's no longer eligible. And usually if you break the foundation, you don't have enough money. We have one of those we're dealing with right now. So those are really the things. They're for basic FHA houses. There's not really ineligible properties. If a house isn't eligible for other FHA financing, it's suitable for a 203K. If the seller doesn't want to make the repairs, then the borrower can finance the repairs and make them themselves. The only restriction really is on luxury items, which are things like outdoor kitchens, saunas, theaters, home theaters, bowling alleys, tennis courts, basketball courts. That's not really part of regular middle-class American housing.
So let me ask you a couple questions, William. One, we talked about there's a limited and then there's a standard. And the limited, obviously, you can do repairs up to $35,000. What's the difference other than the price point? On a standard 203K, I know that there's a contractor, consultant, appraisal, everything has to be done on that loan. Now, do you have all three parties involved in a limited, or is there just a consultant involved? Is it just a contractor involved? What happens there? Can you do the work yourself?
So the first answer is no, you can't do the work yourself. I always get that on the table. We don't do self-help at all. We don't let your uncle or your cousin or your father or your mother or your brother's uncle or their dog do the work. It's got to be somebody in arm's length transaction, because we found it just doesn't work. If the contractor's not contractually getting paid to do the work, we usually have problems in the escrow side. So you can't do the work yourself. That answers that question. That's on both of them. On the limited, because it's a smaller loan and it's designed for cosmetic things, we can go with up to 3 discrete tradespeople. So you might have a plumber, an electrician, and a painter. And each one can bid on their part, and then we can pay them as they finish the work. So the limited is going to be, all these are borrower driven, so you really want to make sure that your borrower is able to find a contractor, which in 2016 is really quite simple. There's like 3 or 4 online companies that come to mind off the top of my head that people use for contractors. But we give you 3 just to make it easier on the borrower. On the standard K, the way HUD sees it, and they just redesigned they just redid the guidelines. So now we're using the 4000.1, which is a new HUD handbook. And it really clearly states that they want the consultant to act like a HUD consultant in the sense that he prepares the scope of work. So ideally, the borrower will find the property, write their offer if it's a purchase, and get their offer accepted, bring it to the loan officer, who would then send it to my group, and we would engage a HUD consultant who would meet with the borrower at the property and go out and define the scope of work really in detail with prices so that they know what the project is. And then the borrower should ideally take that document, photocopy it, blank out the prices, and have contractors bid on that exact scope of work, so they're always comparing apples to apples. And it goes pretty quickly.
So let's get kind of into the nuts and bolts of the K. When you have let's just say, what can we use it for? I mean, I know that you can, do repairs with it, whether it's leaky roofs or, handrails, things of that nature. And you can also do, like you said, cosmetics. What else can be a part of that? Can we, we can renovate the kitchen, obviously. We can use it for tile. Can we use it for appliances? Can we use it for new HVAC system?
We can do all those things, appliances, HVAC. One thing to consider, especially with older homes in landlocked neighborhoods, houses built in the 40s, 50s, 60s, maybe earlier, that are single-family homes that are small. And they have no room on the sides, no room in the back. So what you could consider is doing a standard K and raising the roof and adding a second story and reconfiguring the house inside. So that's kind of the get your dream home in your old neighborhood. You want to move back to mom and dad's house, but when it was built in '63, you guys were all jammed in one bedroom, and now you got your 3 kids and you don't want to jam them in one bedroom. And so you raise the roof of your parents' house and make it a 2-story and reconfigure the inside. So now it looks like a house that was built in 2016. So really, there's a lot of versatility for the loan besides the repairs. They're not really just for houses that need work. I could buy a house that's perfectly maintained by a family that's raised their kids in it, and the kids are all gone and they want to downsize, but it's clean, it's well maintained, but it's dated. So I could use the K to upgrade the finishes. I had a guy come out to my house yesterday and talk about windows, and they don't build windows in 2016 like they built them in 1976 when my house was built.
Yeah.
So I got to change my windows because the molding is all different, right? Well, they have other problems, but you know, things are different. The countertops, the surfaces are different in your kitchen. The bathrooms are different. Flooring is different. We have a lot better choices for flooring. There's energy improvement things that you can make. There's just a lot of things. Anything your house needs that's supported by the appraisal, really you should consider doing a K to do it.
So let's touch on some of the things that you were saying. One being, you know, can you use it on the historical homes? You know, that type of home where you want to go in and it's a certain type of window, or do we have to get a certain type of contractor in if you're in some of the, you know, Philadelphia being one of those areas where you run into that issue as a realtor or as a loan officer, you're going to have that issue.
And yeah, we can do that. I've done several historical homes in my previous place of employment, and when I was an originator, I've done some in Indianapolis and St. Louis. And ironically, the guys that came for the terrazzo, the Italian tile, he came from Philadelphia to do a kitchen and a bath in St. Louis. And the guy that came to fix leaded glass, stained glass windows, where the windows were totally rusted, in Indianapolis, came from Philadelphia. The ironworker came out to fix the windows.
Of
so
course.
You can do historic homes, right? You got to deal with the historical society. So, you know, the borrower needs to know what they're in for, because if it's a historic home, really they're talking about a restoration, and you're going to have to follow their guidelines. But it's perfectly eligible to be financed with the K.
Gotcha. Okay. So let's you talked about luxury items before that they're not included in a K. Give me a few examples of what a luxury item would be.
Stainless steel counter, stainless steel appliances, marble are perfectly fine. I just said that so people would really pay attention.
Okay.
That's not considered a luxury item.
Right.
That's part of your house. So when HUD says a luxury item, you're talking about the jacuzzi on the deck. You can add a deck to your house if it's supported by the appraisal, but you can't finance the jacuzzi to go on your deck because that's a part of a house that's not part of a regular middle class home. You can repair a pool, but you can't put a pool in. And if you got to have a tennis court because you got a big backyard, you can't do that with the K. So really, they're talking about really specific things. Outdoor kitchens, you know, your gazebo and your Viking gas grill on your patio. You can't do those. You could do new appliances in your house. You could put a Viking stove in your house if it appraises. But if you're going to put it on the patio, then it's not eligible for K financing.
Could you would a patio, or let's just say a paver patio, an E.P. Henry patio, either on the front or the back, would that be considered a luxury item? Because that could add value to your property, whether you're creating a little bit bigger outdoor living space. Would that be considered?
They're not luxury. They would be landscaping.
Okay.
You have to get value for doing them. You have to get value out of adding them.
So you could add landscaping to any of the Ks. You could add trees, lighting, asphalt, whatever it may be. You can add a driveway. Would also be considered an improvement that the FHA or HUD would allow?
Yep.
All right.
And our guidelines are pretty straightforward. I have them here. We tried to make them for our salespeople, so they say very clearly what you can do in there. And all those things you just mentioned, they're stated right in HUD's guidelines. So
Great.
Driveways, walkways, your patio, everything has to be supported by the appraisal. So if you're trying to upgrade your landscaping and none of the other houses have any landscaping in the neighborhood, you may not get value for it because he's got to get a comparable value for whatever it is you're trying to do. And so oftentimes in some older neighborhoods, the first one to do the K is the hardest to get value for. But once somebody does it, then they have comps that they can use to reflect that.
Gotcha. So let's get into, you did talk about a tear down and a rebuild, because I often get the question from some of our salespeople that, hey, can you build a house with a K? I walk into a neighborhood and there's a one-level rancher that's there, and the family says, well, I'd love to, buy this house, but I would want to tear it down and build it from the ground up. So as long as you're within the FHA loan limits, that is allowable?
It's allowable. It's a little trickier because they have to use 100% of the existing foundation. So they can make it bigger. They could expand the footprint and make it bigger in any direction, but they have to keep the original foundation as part of the building.
So they could expand the foundation though. That's what you're saying, William.
Right. They can expand it.
Got it.
But they can't tear it out into bare ground and start over.
What happens if they tear down and they find out that there's a crack in the foundation or there's an issue with the foundation? What happens then?
So we should actually have found that before they tore it down, because they're going to have to get an engineer's report that tells us the condition of the foundation.
Okay.
Because they're going to support, either they're going to build up or they're going to build out. So it's trickier if they're building on the existing foundation, because they often have to repair it. But if they're going to repair it either way. But if they're expanding the footprint, it's not as complicated as when they're trying to add weight on top of that foundation.
Scott, you want to just chime in right there?
Yeah. We got a bunch of viewers, so thanks for being on, guys. Just so you know, up in the right corner, there's some little squares. Click in there. There's a Q&A application. It's like a green-blue app. Click on that. You can ask us questions, and William and Jay will get those answered live here on the Hangout. So please, let's make this interactive. Ask some questions. I had a couple, if I don't mind, Jay, if I ask William. William, for a realtor, what's the, actually I got two questions, but I'll start with this one. What's the benefit for a realtor to bring this up to a client of theirs or a borrower or homeowner? Why would they even broach this or bring this subject up?
So the advantage to realtors, there's several advantages to realtors. The first one is to sell more houses. Okay, so if I was just talking to a room of realtors, and if there's any realtors on the phone, welcome. And what I'd like to ask is, how many houses do you have to show the average borrower in any given market? So in most markets where there's ample housing stock, they're showing them more than 1 or 2 or 3 houses. And so the question to you, is it because you're not good at your job, or is there something else? And usually it's because there's something else. The way the realtor process works is if I go to a realtor, they're going to interview me. They're going to fill out this extensive questionnaire. They're going to identify what my price point is, what floor plan I'm looking for, type of house, neighborhood, all the considerations that I have. They'll go into the MLS, and they'll pull 3 or 4 or 5 or 6 samples that match, and they'll start showing me houses. Right? And so the first question that they need to be ready to ask people, I go see the first house, and I like it, but I can't stand the kitchen. It's like backwards, or it's avocado green, or they didn't upgrade the kitchen, or whatever they did I don't like. But everything else is perfect. So the realtor needs to be willing to ask me what I call the $1 million question, which is, William, like, this is your house. It matches everything you said you wanted, except that that's not your kitchen. So would you be willing to finance, would you be willing to write an offer if you could finance remodeling the kitchen so that it was the way you wanted it? I probably don't know that that's possible. The average borrower doesn't even know that that's possible. But what most realtors do is the borrower says, well, no, I don't know. Let's go look at some more houses. And they put them in their car and they drive them around. So I think if they want to sell more houses, then they really need to learn, A, which houses are going to be suitable for FHA financing, or which houses might fail even a conventional appraisal. I have a conversation pending with someone who failed the appraisal on the roof. It's a $15,000 roof. The seller's not doing it. So what are they going to do now, right? The solution is to turn it into a K and finance the roof.
All right.
So recognize issues that would be appraisal issues or property value issues, as well as be willing to help the borrower see that they can make changes to the house to match what they want, if everything else is what they want.
And one of the marketing pieces that we always go back to, and William and I have spoken about this at length, is, if you are the realtor in that area and you have that listing that's been sitting and it's not getting any traction, there's nobody coming through the door, getting that CAD file or getting that, hooking up with the contractor in the area, or connecting with maybe the architect in the area to give you a design, a rendering of what that kitchen could look like or what that house could look like, a before and after shot. And Scott, I know that I sent some of them over to you. If you could pop them up on the screen for me, I don't know if you could do it or not, but that would be great if you could, just to give people some idea of what this would look like. And for realtors, it's a great trait to have. And one of the loan officers that's here, it's been around for a long time, Roger Hope, him and I were having a conversation, and one of the things he used to use the K for, he would have a cabinet sample at the house along with a carpet sample that he had at the house, so that when people came through on that open house, you could add the carpeting, you could see the different types of cabinetry that you could have there. So it's a pretty good, it's not a pretty good, it's a great loan if it's utilized properly. So while Scott's trying to pull that up, William, I do have another question about the 203K. So can you use it for repairs, storm, flood damage, mold remediation, things of that nature?
So storm damage, yes. Water damage, yes. Mold remediation, yes. Pretty much anything that the house needs to restore it to market value is eligible for a 203K financing. Someone did ask a question about landscaping, but if you look in our guidelines, which are HUD guidelines right from the 4000.1, landscaping is an eligible item. Tree work is not eligible, tree trimming and pruning, unless it endangers the property. So overhanging branches, things that rub against the house, where there's a fall danger, you might be able to take those trees out. But as far as general landscaping and site improvements, you can do those with the K.
Okay, so to answer that question, the tree removal, you can only use the K, the money from the K for a tree removal if it's a hazard to the property. Can you use it if it's butting up against, let's just say, your curb outside of the home, where the roots start to now create that buckle in the sidewalk that becomes a hazard for people that are walking? Is that something that you could use that for as well?
Yeah, you can use it for that, because most municipalities require the sidewalk in front of the house to be maintained by the borrower, by the homeowner.
Right.
Yep.
So hopefully that, I don't know if that answers, I'm pretty sure that answers the question. There's another, I understand the rewards and benefits of the 203K, but with the expense of FHA MIP, what's the recapture time frame for us in sales, as well as seasoning for a homeowner to transition into potentially an inexpensive loan payment? Did you get all that? That was a mouthful.
Yeah, I'm looking at it. So they want to refinance the person out of the K into a conventional. They got to go at least 180 days.
6 months.
And the work's got to from when the loan closes. They can't do it until we close them out in connection. So they're going to be at least 6 months in the property.
Right.
Hey, can you guys see the picture on there?
There you go. Yep, see it.
All right. So if you want, we can just go through these. Why don't you explain them, William?
Yeah, I mean, if you could just go through, Scott, and this is a before, some before shots and what it looks like, and then after.
Oh my God.
Yeah.
All right. So wait, before, after.
Right.
Wow, look at that.
Yeah. So
they opened it up too.
Yeah.
Right.
So and that's the thing. What you need to do is you have to have when you give people that visual, right? What you're seeing right now is the visual. That's a rendering. That's not a real photo. That's actually a CAD file. That's something that's
that's not a real photo.
Built on a computer. But it gives you the visual of what that kitchen could look like. And you see how there's designs and walls are every which way in that room, and you remove a wall and you give people that visual. So this is what I was talking about, when you can get on and you have a realtor that you can provide this to them, right? You put this on a piece of paper and it shows them, right? Maybe we set up an iPad at the open house and it has this rendering that's sitting on there. So people have the visual. And then you have the contractor there, and he's giving you the price of how much that's going to cost to do that to the kitchen. And then you are there as, obviously, the loan originator, the loan professional, and you're explaining how this loan will work and how you can finance a majority of that cost, which most borrowers nowadays don't have the money to do that. A lot of people just don't save. People love the house, the street that it's on, love the school district, but the house isn't. It's outdated, as William said. So what are some of the things that can get you into the house? And you as the realtor, for some of you realtors that are out there, this is such a strong tool for you to help create more sales, so that when you have an answer to any buyer's objection when they walk into the house, well, I really don't like the kitchen. Well, you can finance that. We can get it. What don't you like? Would you like to see white cabinets? Would you like to see a granite countertop? Yes, I would. Would you like to see a brand new bathroom? We can rip up the carpets because it smells like a cat, whatever it may be. You know, you're ripping down paneling on the walls. You know, sheetrock and paint. There are things that us as professionals in any part of this, us being the loan officer, the realtor, having this tool and knowing this loan is so important, and I think it create and generate so many more sales. So I know that there's, you know, we didn't touch on some of the things. There's a contractor, there's a consultant for some of the people that really aren't familiar with it. William, if you could touch on the contractor's role, or let's just touch on the consultant's role. What's the consultant's role with a K?
Okay, so really the consultant is a person that has been either a general contractor for the licensed GC, or they've been a home inspector for 10 years or more. And so they get registered with HUD, and their job is to, and this is a little tricky because their job is to protect the interests of the Secretary of HUD, the lender, and the borrower in that order. And they work for the lender, and they're paid by the borrower. So they are essentially the construction supervisor. So they'll draft up the initial scope of work and make sure that any HUD minimum property requirements or safety issues are addressed in the work so the house meets HUD guidelines when it's complete. And then they will manage and oversee the inspections and the draw process to sort of an interface between the borrower and a customer. So, for example, I had a conversation with a potential borrower this morning in our retail office next door, and they were looking at doing a HELOC versus doing a 203K to expand their house. So the HELOC is based on 80 to 85% of the as-is value of the house, and he's on his own. He just gets a check from the bank, and he's got to deal with the contractor on his own. The 203K, and it's also prime plus or minus whatever, so it's not a fixed rate low interest mortgage, and mortgage rates are still pretty low. So, you know, from my perspective, the K is a much stronger vehicle because on his particular refinance, we're going to use 97.25% of the as completed value for his loan to value. So he gets more money. And then he has the infrastructure of Finance of America Renovation Lending Division as an interface between him and the contractor. So the contractor doesn't get paid until the HUD consultant approves of the work. And so there's not any, it just clarifies all the relationships when everybody understands this is really his job. He's his construction supervisor. Contractor's the builder. He's going to do all the work. And then the borrower, of course, the homeowner, signs off on it. And then we release the check. So it's good for contractors because they don't have to worry about the guy going and buying a skidoo or a boat or taking a vacation with the money that they were going to pay him after he started, because I got the money. We're holding it in escrow. We pay it out when he does the work. So I think that maybe that answers the question. Maybe it doesn't.
Yeah, no. It does. Now, can we, as the loan officer, can you use your own consultant with your department? Could we, you know, recommend a consultant that we've used prior to or that we know of in our area?
Sure. So, you know, in the past, the loan officers were actually responsible for finding the consultant. So one of the advantages of our new division is we manage all of that. We really want salespeople to just be originators and set the initial expectations, and we kind of do the heavy lifting. But if you have consultants that you've worked with in the past that performed well, by all means, please tell us who they are. We're not opposed to using them. Okay, we'd be happy to work with people that know how the program works and have good reputation, because really when we interview a new consultant, we're just trying to figure out if the person's likely to come off their meds before the job is done. So if you know that there's somebody out there that we don't want to work with, we would appreciate you telling us that, because they might sound perfectly sane on the phone, and then when they get into the project, you know, all the wheels come off the wagon. So yeah, we definitely want to know one feedback from sales regarding consultants in your particular markets.
So we also want to know about the bad one as well, right? I mean, I shouldn't say bad, but ones that maybe aren't so they don't respond in a timely fashion, or that aren't really helping out the situation.
Right. And there could be a lot of things. It could be they don't produce. They're too slow to get a draw request. They don't answer the phone. They're cranky and cantankerous, and they don't work with the borrower. We need them to facilitate kind of keeping the project moving. And so they have to really understand that really the borrower is the homeowner, and their job is to facilitate them getting the job done the right way, the way they want to have it done. And there's a lot of good consultants, but there are a few that you really don't want to work with. And so, like I said, if you guys know of any, I've got a list from some people that have done Ks at Gateway for a while that told me, don't use so and so, and we appreciate knowing that. We just crossed them off the list.
Yeah. Okay. So is there anything that you have in place? Say, one of our branches, maybe in Chicago or somebody in Florida, they don't know of any consultants. This is something that's new. Do you have a process that vets consultants versus end contractors, to where they can use it to solicit or at least offer to their buyers, to their borrowers, hey, look, here's 3 different contractors that we have vetted or that we know of, or are we just going to solely leave it up to the buyer to find those contractors?
I actually prefer leaving it up to the buyer, because when the deal winds up in court, I don't want it to be my guy that's in court with them. And it really is, there's, after the heyday and the collapse of the mortgage industry, a lot of the guys that were like working onto the back of their pickup truck, those guys are off doing other things because it's too hard to work now. So most of the contractors I've seen most times this is their family business. It's what they want to do. And you can go to Angie's List or Handyman Connection, HomeAdvisor.com, Better Business Bureau. There's lots of resources where they vet the contractors already. If you can get the names of the guys that sub for Lowe's and Home Depot, they go through an extensive vetting process. So there are quality contractors out there that are fairly easy to find. And it really would be the same if they were the homeowner already. They have that's part of owning a home, is finding people to fix it for you.
So, one of the questions that we have here, if you're having a bad experience with a contractor and they're not coming out to the project, or they're not using the same material, are you able to fire them and get another one?
There's a process to relieve them of their duty, yes. So, they start off, when you present the contractor to us, we're going to do a public records background check. We're going to check their references. We're going to make sure, do our part of diligence as a lender to make sure they should be part of the transaction. So if they get through the initial screening, it's your choice, but we screen them, and if we find that they're maybe not suitable, we'll tell the borrower that, this contractor is not suitable. Right? But if they assume that they're suitable, they seem suitable at the beginning, and something happens in the middle, then the process is for the borrower to be talking to their escrow administrator who works here with us in Noblesville. So everybody is a person that's dedicated to managing their escrow and responsible for overseeing the disbursement of funds. They let that person know that it wasn't working, they wanted to get a different contractor. So we essentially have to close out that contractor's work, have an inspection by a HUD consultant or an FHA fee inspector to determine what's done on the house, and then make sure that he's all paid, make sure there's no lien waivers from him before we square him up, and then they can get another contractor that we would vet and do the same thing. So it's complicated. It can be done. I just try and tell borrowers to follow your gut. You check their references, I'll check their references. I don't meet him personally. You meet him personally. Look in his eyes, look in her eyes. Check their people whose houses they've worked on before, and follow your gut. And usually you'll be all right. Most of the time, people aren't having problems with contractors. It's just when they do, it gets on the headlines.
And that's the important piece of having the consultant there, because the consultant is there to verify their pricing, the work that's being done, and the time frame that it's going to allot for the work to be done. So, there are some moving pieces to it, and that's why there are consultants. That's why you have the contractor. So there are some security blankets there that will help you. But as William said, yes, you can. Another question is, can you utilize a K to develop vacant land? So if we had an approved lot that there's no structure there, it's totally approved, has everything, all the water there, plumbing's there, can you build from the ground up? Can you use a K to build from the ground up?
So officially my title is Director of Renovation and Construction Lending. So right now my business card says Director of Renovation Lending, because we don't have any new construction products. So the site development and stick built, that's the construction that isn't happening yet. It's got to be an existing house. It's got to be there for at least 12 months or have a certificate of occupancy.
Okay.
Yeah.
And to answer the question that somebody had asked a question about getting sample images that were presented, the before and after. Yes, we will have them. I'll get with we'll get those up on our website. And to touch on another question that related to this is the marketing material. We'll have all of these things up onto our website shortly. We'll get everything there, some more marketing flyers, some of the before and afters that you can use. But as far as a flyer for, you know, what I was talking about before, when it's an existing listing, is you going out to that listing, you connecting with a contractor, connecting with an architect in your area, building your own network, and going out there and saying, hey, listen, can you give me a rendering of what this kitchen could look like? Because you want to use a before and after of the property that you're doing the open house for, right? You don't want to do a before and after of, you know, some mansion that's in a suburb of, let's just say Chicago, and you're doing a row home in Philadelphia. So you just want to kind of make sure that you're utilizing it and give people, it's all about the visual. You want to give them an idea of what that kitchen could look like, the one that they're looking at right now, that you actually can do that. And if you align yourself with any contractor or anybody that, any architect, they'll be able to give you that. They would be able to hand you that information. So I know, you know, we're touching on the 203K. We do have a question about the home style. What's the difference, the Fannie Mae home style versus a K? What are some of the nuances? What are some of the things that you can do in a K that you may not be able to do in a home style? Or is there a difference?
So what I prefer to do is to defer all the questions about the home style to the product that people can sell, because at the very first mention of it, I have already fielded more requests and scenarios for it since the sales rally than like 1 or 2 a week. So I don't really want to talk a whole lot about it. It's a beautiful conventional loan, but we don't offer it yet. So when we get it, we can do another hangout and go through the differences.
So we're going to do a renovate. We're going to do a renovation hangout. And I'm sure I'm going to have questions on the construction to perm as well, William. As you know, that's something that's on the launch pad. It's down the road. It's not going to be here anytime soon. You know, but the thing is we really have to focus on how good William is at this product to advance the other products. So we need to sell this product. It's a great product. It's something that that obviously William knows inside and out. He has a full-blown team that handles it from the onset, after application, all the way through closing, and he's going to handle the draws that happen after the fact. So one of the things I also wanted to touch on, William, is a contingency. Mm-hmm. How is the contingency? How did they come up with the figure or the factor?
So I mean, really, a renovation loan is a sort of a shot in the dark, right? It's not like a new construction where you have plans and you have a material list, and you know it's like a box that you can get. Like I said with the kit homes at the rally, you can get your house in a box and you know what it's going to be. Problem with the renovation loan is that you don't know the condition behind what you can't see. So if, say, for example, someone is going to take off the summer kitchen off an old house and you know, modernize it or update it or something, and they take the cabinets down and there's raccoons that have been living in the wall. Well, you got to have money to take care of the raccoons and repair the damage and do all the stuff, right? So the contingency is really 10 to 15%, up to 20% of the hard and soft costs of the job. 10% is required by HUD. It's a safety net, right? So it's really designed on a limited K. It's designed for unforeseen things that come up during construction. If they don't use it on the limiting K, we apply it to their principal. There's no really provision to use it if they don't to do more work. If they're doing a standard K, for example, say they've done a $100,000 reno job and they have a 10% contingency reserve, well, that's $10,000. And by the time they get to 80% or some completion of the work determined by the HUD consultant, if they want to do additional work, maybe add on to their project, they could use the $10,000. They could use the last dime of it, right? So it's really factored in by the cost of the project. It's always 10%. It will be 15% if the mechanicals aren't functioning. So I do want to address the mechanical service. There's a little bit of confusion around the utilities, right? Oftentimes the house is winterized or the utilities turned off or the seller won't turn them on. So our dilemma is that, and this even impacts HUD REOs, HUD requires the appraiser to comment in his report whether the utilities are functioning or not. That means you got to turn them on if they work. If the house is winterized, they have to de-winterize the house, or I have a loan that's not insurable because if the appraisal will fail the HUD audit, right? And so people just have to wrap your brain around the fact when the appraiser gets there, he needs to be able to say if they're working or not. If it's winterized, he can't tell us, and you can tell it's winterized from the appraisal pictures. So they got to dewinterize the house for that. If it's broken, say the pipes are damaged or it froze or the copper ferries came in and took the metal back to the mountains or whatever, and there's no pipes, then we don't want to turn the water on when it's going to run all over the floor. The reserve will be 15%, and we'll have a bid to fix it. Okay, so that's kind of how that really is supposed to work. You can't just assume that they may work and increase the reserve to 15 or 20%. The appraiser is the linchpin to holding this together.
Can you, with that reserve, can you upgrade anything? Say you wanted to upgrade countertop. You're going and and you have everything priced out. You go and you see this countertop. You want to pick this countertop out, and then you're into the project, and a different stone comes out, and this is a nicer granite than you originally picked out, but it's about $1,000 more. Can you tap into that reserve, contingency reserve, for that upgrade?
Yes, you can. And so that's going to be between the borrower and the HUD consultant. The consultant will do a change request, which we would normally approve, but it's really going to be the consultant's going to say that it's okay. They're not going to need the reserve for something else. So if he's pretty sure when they're putting the countertops in, they don't need the reserve for something else, then they can upgrade their countertops or their cabinets or whatever. If it's early in the project, he may not be able to release the reserve because he doesn't know yet until more of the work is done if he's going to need the reserve. But the answer is, can they upgrade to the question, can they upgrade, is yes, they can upgrade their project using the reserve money.
Okay, let's touch on, I don't use any of my reserve. And my loan's done, we seal all the doors, the windows, everything's fine, I'm in the house, but I had this contingency reserve of $10,000, $15,000. What happens to that money? Can I get that money back into my pocket?
Can't get it in your pocket. We will do a principal abatement, so we're going to apply it to your principal. So your mortgage principal will go from $280 to $265. Your payment's not going to change because it's a fixed rate, fully amortized loan. But when you decide, say you wanted to refinance, someone asked earlier about refinancing to a lower conventional and avoid the MI, you might be at an equity position with the principal abatement. It makes sense for you to refinance the conventional loan, you're paying for it out of your equity, and you get away from the MI. So yeah, that's how that process works. The borrower can't get any money back unless they brought it. So say you brought $15,000 for a reserve yourself, and sometimes people can do that to keep their loan small, right? So they'll bring the money. We don't use it. We can give it back to them. But that's the only time they can get it back is if they bring it to cash at closing, and it's really complicated. Although with the new CD, it's actually easier, I think, to see it than on the HUD before. So if they bring 15 grand for contingency, so their loan amount is at the limit they want, and we don't use it, they can get a check for that back. But if they didn't bring it in cash, they can get it in cash.
So let's talk about the contractors, because it's a very common question is, can my brother, my cousin, my buddy down the street, can he do the work for me on the limited?
So the first thing about the contractors, they have to be licensed and insured, bonded if it's required by the municipality or their type of work. So those three things we have to have evidence of. The other part, we had a deal several years ago where I was working where we used the uncle was the general contractor, and I think the loan closed around June, maybe May, and we hadn't heard from him for a while. So we hadn't had a draw requests or anything. So we call up the borrower to find out how the project is going, and he said, "Well, my wife had a fight with my uncle. She won't let him back in the house. We're going to talk about it as a family. They're all builders, the whole family. So we're going to get together and we're going to figure it out." I said, "When are you going to get together?" "We're going to get together when we meet." I don't know if it was Labor Day or Thanksgiving. It was about 90 days out. Okay. So what happens when you have family things is you have family things. So we really need an arm's length transaction between the borrower and the contractor just to keep the air clear. And so they can't be family, they can't be related. If they could give you a gift, according to FHA guidelines, they can't be your contractor.
Okay. So, and just to somewhat touch on that, with the contractor, so you're telling me that they have to vet it, they have to find the contractor, we'll find the consultant. There is no consultant on a limited, correct?
Right.
So that's right. So how are the draws? How are they paid out when there is no consultant to go out and inspect the work?
Okay, so we anticipate that the limited is going to be for cosmetic things. So maybe I'm putting an HVAC back in the house, and I'm having a roofer come out and a painter to paint the interior walls or the outside, whatever. So I got those three guys. So they're all going to get the lesser of the cost of their materials or half of their bid amount at settlement. So when the loan closes, we will disperse 3 checks to the borrower, 1 for each contractor for the lesser of the cost of materials or half of their bid amount. Because HUD envisions the limited K own a project that you can just get in and get started and not be out of your house for 2 to 3 or 4 weeks. It's done. That's the ideal for the limited. Okay, so and then when they finish their work, we pay them. So we pay them as they finish. I know some other companies pay them when it's done. That doesn't really work in the real world, because in the HVAC guy in particular, it's going to take him 1, maybe 2 days if he has to put duct work in to be done with his job. And when I tell him he can't get paid until the cabinets are in and the cabinets are back ordered 6 weeks, he immediately goes and files a lien against that property, right? And he starts calling the borrower at 7 in the morning, every morning, to find out when he can get his check. So we pay them when we inspect, and we pay them when they're done. We use the appraiser to inspect the property on the limited, and then the HUD consultant does the inspections on the standard.
Okay, so the appraiser is the one that actually goes out and does the final inspection on there.
And then on the standard, they don't get any upfront money except for special order materials.
Okay.
So the contractor really has to be big enough to carry the job.
Okay. So let's talk about expectations. When I'm a loan officer, I'm excited about doing this 203K, and the realtor is signing the agreement of sale that night. What expectation do you set? What's the right expectation to set on a K? Is it 30 days like a typical transaction, 45 days?
We recommend 45 to 60 days. Most limiteds can be done inside of a 45-day schedule if the borrower is motivated and there's no extreme property issues. It's not like a rural property or a unique property somewhere, but it's, say it's a row house in Philadelphia, they're just doing some stuff inside. That can typically be done within 45 days, unless the borrower falls down getting their contractors. Right? And so we can help them somewhat. But what I try and tell borrowers is just to imagine that you're living in this house, and you own the house, and you wake up in the morning and your upstairs bathroom is pouring water into your downstairs bedroom. You're not going to call your loan officer. You're not going to call your realtor. You're going to call a plumber. So as you get ready to buy the house and you need plumbing work, go find a plumber. And if you help them do that, and we help them, our project managers and processors will work with the borrower to help them find their contractors and give them direction. But that hasn't really been the issue in the years that I've been doing loans, is the borrower finding the contractor. It's the minority of borrowers who are doing the K that have a difficulty with contractor. But you do want to make sure that you're telling your realtors that you need 45 days. And there's specific language that HUD requires to be in the purchase agreement, and it's in our seller guide. It's also in the presentation that's in the training material. It's just one phrase that HUD wants in the contract to protect the borrower's earnest money, essentially, and to advise the seller that they're doing a 203K, and so here's a heads up, something may come up that needs an extension. If you start out with a 45 or 60-day contract, we'll get the majority of those done inside the contract date.
So, William, I got a question for you. If you're a loan officer and you're working with one of your referral partners or realtors, and they've done this before with another mortgage broker or LO, and it hasn't gone well, what pitfalls or what training or marketing materials or things that do you guys have that you can help your LOs so that they can convince these realtors that this is a good way to go to help the borrowers?
So what's going to come down to is process and execution. We will have marketing materials that kind of highlight that. There's already a process chart that they can share with their realtor. So the biggest difference that I see with the lenders that offer Ks is A, understanding the product, and based on their understanding, staffing to execute. So one of the things that FOAM, Finance of America loan officers have, is my whole division. There's 10 of us now. We're hiring, 2 or 3 more, 4 more people. We're staffed to close, a large number of units every month. And then we also have a process that I built at my previous employer. So I've been doing loans this way coming on 7 years now, and it actually works. So the loan officer really has to understand our process and then meet the realtor at their points of pain and their negative experience. If they say it took too long, ask them about it. Why did it take too long? I can generate numbers that show you it doesn't need to take that long. At Finance of America, if the loan officer brings us a complete credit app after the borrower signs his purchase agreement, we're going to have an underwriting decision within 48 hours. So then everybody knows that the loan is conditionally approved. All we have to do is go get the outstanding credit docs and the renovation docs. And our processors and project managers are working with the borrower to get those things done. So we've got a process in place that helps. It's really just a huge back office for the salespeople, because most realtors, if they're looking at the loan officers, they don't think the loan officer can get the stuff done, because most of the time the loan officer can't get the stuff done, because most of the time it's not their job and it's not even what they're trained to do. And so our process divides the labor so we can conquer it and deliver results that are pleasing to everybody. So they can tell them, yeah.
So talking about your process, and I know that you've spoken about this, do you still do your welcome call for the loan officers that are watching this? Do you still do your welcome call with your customer base and the clients, just setting the expectation with the borrower as the LO is on the phone with them so that they get an understanding of the expectation, what they can expect next, and how this is going to move forward?
Yes, so we do welcome. So what happens is, for the loan officers, you will take your app, you'll upload your docs to XDocs, you'll send in the renovation lending submission sheet to an email. The reason we're asking you to do both is because the XDocs indexing makes sure that all the docs are there, and the submission is kind of a backup in case we miss the X submission. We know to go look for it because I got this submission checklist from you that says you sent this K in. So we go look at it. Once we do that, after the underwriting is done, then it gets assigned to a processor, and who's also a project manager, and they will call the borrower, explain the loan to them that they're signed up for, and offer any insights or help that they need to get going. We're generating a project calendar, which takes the contract dates, puts it on a calendar, shows who's responsible to do what by when, and we base it on the contract time frame, and that goes to the loan officer, both agents, and the borrower, so that everybody can see who's responsible for what and what's supposed to happen. And so we'll know up front if we don't think we can get it done, it won't work on the calendar, right? If you send me a 30-day contract and I plot the average time it takes for underwriting, processing, appraisal, clearing conditions, generating your CD, if it doesn't fit inside that window, then we can tell you up front it's not going to fit inside the window.
So let's touch on one of the questions that we've had before was, can you use a 203K to turn a single family into a duplex, to where you want to create rental income? Maybe you're a renter and you're trying to buy a home, but you need to offset that payment. You can qualify for it, but you want to create that single family and make it a 2-unit. Now, what happens with that in Philadelphia, for example, is that you have zoning. So you would have to get your zoning changed and everything. Can you roll that into a 203K, or would this have to be something that was previously zoned or zoned for both? How would you go about that?
The hardest part is the zoning. You're going to have to get the zoning changed. But if the borrower can get it zoned properly, they could take a 1-unit, say it's a ginormous, like in the 70s, there were a lot of big homes that people turned into sort of duplexes or triplexes. And now we have people who want to buy these big houses, but they don't want to rent them. And so they're converting them back from a three-family home to a one-family home. So you can do that. You can go up or down, as long as the zoning can be worked out. And you can do it inside of your K, and then you can follow FHA guidelines for including the rental income, for your qualifying income.
So some of the marketing, we'll get into the marketing, and you can find some of this marketing material. It's going to be on foamortgage.com under marketing, and then under marketing you'll find renovation. And we're going to upload some of these photos on there. I'll have Keith Gobern, who takes care of our marketing, upload some of these photos, get everything on there, and we'll try to get some flyers together. One of the things that I thought was pretty neat was having your realtor advertise or sell the home that will be, you say, or put an ad in the newspaper of renovation ready as an ad, which I think is really kind of cool. So touch on some of the things that you've seen prior to, or maybe people that have used this.
So really having a realtor, and it's not for every realtor, it's not for every loan officer, you know, but if you have a realtor that, say, a listing agent, because they often have stale listings or expired listings, or they need to go from a handyman special to a renovation funds available mindset. So, because the average borrower isn't a handyman, right? So it's like Jay said, it's a change of their mindset. You know, you're going to buy the house that could be. You know, so they'll list the virtues of the neighborhood, the school district, the utilities, all the amenities, and they'll show this dog of a house. And then if they do the CAD drawing or anything, it says, but it could be this, and financing is available. And then they're basically selling a new house. On top, you know, it's old bones, but it's a new skin. So really, for realtors, we're going to have to start thinking differently than the way they sell the houses. When they go in to a listing or a house that I'm considering buying, the realtors need to be upfront and say, you know what, I know this house is a dog, but it's got good bones. Here's when it was built. Here's the neighborhood it's in. You know, you wanted to be close to this school, and the school is like a mile away, and you wanted a mall with the movie theater, and it's 2 miles the other way, and so the house is a dog. And they should have that conversation before they go in the house, right? And so the realtor has to set expectations too, because the consumer goes in, and if it looks like a grenade went off, or you know, it had water damage, their brain is like backing out the door while their body walks into the house. So the realtor's got to be upfront and say, you know, this house needs work, but there's a mortgage that you could qualify for to do this because you qualify for FHA loans, so you could qualify for a K, and then we can negotiate the sale price to allow for the condition of the house so that you can afford the mortgage amount and finance the repairs. And then essentially the borrower's buying equity because we're bringing it back to market value. So we've seen our equity gains over the last 6 years all the way from 0 to, I don't know, the highest was 30% equity or something. Okay, so then that's huge because you close a regular FHA loan. At the end of the day, you couldn't sell your house. You couldn't close on Monday, list it on Tuesday, and sell it on Wednesday because you don't have enough money. You don't have any equity, right? Whereas your K, you know, you may come out with 5, 10, 7% equity, which is better in the long run for everybody.
Yeah, and I'll tell you, what I love that you had said to me before was, you know, most realtors advertise handyman special. And instead of advertising handyman special, why not advertise renovation funds available?
Right.
Which I thought was great. I mean, I think that's a great technique for people that see that. Because, you know, a handyman special, automatic, the first thing that, you know, that's either somebody that's looking to buy and flip the property, and it's somebody that isn't handy, that doesn't have the money to do the renovations, is going to turn a blind eye to. So you just, you know, shunned away half of your buyer pool. So, you know, I love that the renovation funds available. I think that's great instead of handyman special. That's a great piece for people to use in your marketing. So that was excellent. Let me ask you something. Because I know we only have a little bit of time left, Keith, and I don't know if there's any more. I mean, Keith, I'm sorry, Scott. If we have any more questions, are there any questions that people have?
I feel like we've gotten to most of them.
Okay.
There's one more from Frank Hanna.
Yeah, we already touched on that one.
Oh, you did? Okay. Then,
yeah,
we
touched
covered
on
everything.
that one. So, William, and I guess, you know, one of the things is we can still use seller concessions on this program, correct? We can still use the full 6% seller's assist?
Right. So the K is going to be, the seller concessions are based on the sales price. The down payment's based on the loan amount. So I strongly encourage everybody to ask for 6%. And even if it's a HUD REO, you know, HUD will give you 3%. So the agents should be asking HUD for 3%. Make a good offer and ask for 3%. On a regular, just treat it like a regular real estate transaction because it's really split in two. The buyer has 2 transactions happening simultaneously, and the realtor's negotiating the purchase price with the seller, and then the borrower's working with his loan officer to determine his loan amount, which will include the renovation escrow. So the purchase is just like any of the realtors should go to the mat for you and get the house for the best price possible. And the better they do, the better you are, and the borrower will be in terms of having to add additional funds for the renovation escrow or the repairs or remodeling or rebuilding, whatever they're doing to the house.
Excellent. So, well, William, listen, I think we gave people as much information as we could. If there are any questions, you can reach William at, what is it, wbrown at
W.
financeofamerica.com.
Yeah, or they can send it to rental scenarios at financeofamerica.com, either one.
Okay.
Rental scenarios is actually better because there's several of us that look at that, and there's only one of me that manages my inbox, and some days it gets pretty deep. But definitely send your questions in. And guys, you should really be selling the product. As spring ramps up, you know, this is a really, really good time to grow your book of business and to increase your referrals using loans that a lot of other companies either don't do or don't do very well.
All right. Well, listen, William, I appreciate the time.
Thanks for having me.
I think we ripped through our hour here on our hangout. So, Scott, I appreciate you moderating this this hangout as well,
Yeah,
Mortgage
no problem.
Professional Hangout from Finance of America. So, Scott, you want to shut this thing down for us? Thank you.
Yeah, of course. So we'll be back next month. Every month we'll be doing the Mortgage Professional Hangout, and we'll have another guest and to bring you guys more education, more value, so that you're learning here from the man himself, Jay Madursky, and we work with Jay doing this video education. So if you guys want to be doing some video marketing or education to the people you want to stay in touch with, you can always reach out to me, Scott at getviral.com. We can talk more about it. But yeah, Jay, why don't you close this up?
All right, thanks, Scott. So, guys, listen, hopefully this was helpful to you. If there's anything that you want to touch base on with me, some marketing ideas or some tools that you'd like to see us use, I will keep you up to date on what's going on with the construction to perm as well as the home style. You can reach me at jmadursky, MODERSKI, at financeofamerica.com, and hopefully I can answer any of the questions that you have. So we'll do our next hangout next month, probably the middle of March, and we'll get that out to you guys. I'm probably going to touch base with one of our top originators in the company and pick his brain on some cool ideas. So we'll get that information out to you guys, and I really appreciate everybody's time, and thanks, and I'll see you next month.
Thanks, guys.